Good afternoon, everyone. Evening for some, morning for others all over the world. Welcome to today's live trade session for TPO. As always, we've got a lot to cover today. A couple of different things that we're going to be. I'm going to kind of introduce a couple of different ideas to you guys. We're going to analyze crazy calendars in a little bit more detail so that y'all can gain a little bit more understanding on how these work and how to take advantage of them. Before we get started, just as always, just want to make a quick announcement that anyone can own stock and trade partner. That is coming very, very soon. And if you want to be a part owner of the platform that you're trading with, then this is your opportunity. Even if you only buy $100 worth of stock, you can do that. So pretty cool situation. I've done a presentation on that several weeks ago, and there'll be more information coming out in the future once it is official and everybody can go to the site and buy. So enough with that. For those that are new on the call, welcome to today's call. And if this is your first time, I do want to warn you that I do not explain everything about these trades on the call. It's impossible for me to do so. The information is meant to be cumulative, and so you will need to attend several calls. That's why we do these twice a week. And there are some here that have been on these calls for almost a year, and they still gain insight out of them. So definitely don't expect that you're going to walk away from this call and understand everything that we're doing. You will not. But it doesn't take that long to really get a grasp. So now I also want to warn you that these trades are fantastic, but you have to be careful. You're going to see some pretty good trades. We've done pretty well, actually really well over the last however many months, and um, you have to be careful about how you put these on. You can make mistakes. You can put the trade on differently and not understand what that difference will do, the ramifications of that difference. You have to be aware of the volatility drops that occur on Friday. So exiting becomes important. So there's a lot of details in here that, once you start trading, you don't want to do more than one. And then once you take these trades on a consistent basis for a month or two or however long it takes, then as your account grows, as you have proven that you can make money with this approach, then you can start to use the compounding and increase your trade size. And you do not need to start big to do well with this. You can start small, and if you can average $100 a week, if you can get to that point, then you can grow your account very, very quickly, as much as 30,000 in the first 6 months. Most you're not going to average $100 a week on these to begin with, but it is something for you to strive for. Fortunately, you don't need to average $100 a week on these trades. All you need to do is average $20 a week on these trades, and you're still going to beat the best performing stock over the last however many years, which was Netflix. And I know everybody's looking at GME now. What if you were in GME? Yeah. I'll get to that here in a second. That has nothing to do with anything, I assure you. Nonetheless, $20 a week, and you're talking about astronomical growth over the next 5 years. And the deal is that it's with a fraction of the risk. You can get into GME, sure, you can get into GME, but if you don't get out at the right time, you are risking a whole bunch of money on a whim, right? So this is a completely different type of wealth building, and much more steady, much less risky compared to something like that. Now, having said that, I have been absolutely inundated at or with questions, I should say, with regard to GME. And I'm not going to spend any time on GME other than to simply tell you what I'm doing. I mentioned this in an email yesterday, and apparently a few people didn't find that email funny. I thought it was pretty funny because I called a bunch of people. I called a bunch of people idiots. Of course, I was being facetious to some degree, and then to some degree I wasn't. But nonetheless, if you didn't get that email, basically this GME thing, the market has just gone crazy, as you well know, because of what I call red idiot warriors, if you want to. If you want me to pronounce that a little clearer, and of course, what they've done is they've got this moral outrage against short selling stock, having no clue what the benefits of having people shorting stocks are to stock investors. They really don't understand. But nonetheless, they've got it in their head that that's just immoral, and so they decided to gang up and say we're going to push all the people that are short selling out. So they did that. It worked. That's happened. It skyrocketed, and you should not be anywhere near this thing. It's for gamblers. It's for people who have no desire to actually build wealth. They just want to get rich quick. And if that's the case, you're toast in the water anyway. So what am I doing? I have been trying to sell puts, $10 puts. Yes, you heard that right. $10 puts. The market trading at 350, 400. I'm selling $10 puts, and I'm not talking about for a penny or 2 pennies or anything like that. I got filled today on February 26th, $10 puts for $1. That's 10% in less than a month if they can just keep GameStop above $10. And if they can't keep GameStop above $10 and it comes crashing down, guess what? I'm going to do it again. And so you just have to be willing to accept the risk if GameStop comes back down below $10, crashing in dramatic fashion, which I think it will crash. It already has. It crashed today in dramatic fashion, has bounced. Whether it comes back down to $10 or not, who knows? But if it does, that's a great thing. So because there's going to be all the premium on those things is just going to be ridiculously good, and so that's what I'm doing. That's enough of that. Let's move on to TPO because I know people were wondering. Just don't do too many. Right, you got to make sure that you can accept the risk if GME actually does crash that far that fast. All right, now let's talk about option insanity real quick. We had an interesting scenario in the market yesterday. This is a great thing about what we do is we don't necessarily need the market to move and close where we need it to close a lot of times in order to take a decent profit. So on this trade right here, this is a 5-to-1, 382, 392. It's 212, 216. I'm not sure where that thing is right now, but I was making about $100 on this trade as of this morning at some point. And yesterday I was making a little bit more than $100. The credit on it is 285, and so obviously I would have been just fine. Some people might ask, okay, we were down at 372. You have a $100 credit. Why not get out at that point? Well, the reason, or $100 profit, the reason is because if we're trading at 372, which is what we were doing yesterday, and I have a 285 credit on this thing, I'm just better off holding. If the market stays down, eventually I'll make $285 or thereabouts. If the market moves back up, we've already moved so far away. So we moved down to 372. That's 20 points away from the short strike. And yeah, it could bounce, and obviously did today, but it was still trading way below this profit zone. So for me, as soon as things quiet down a bit, this thing is going to show a pretty decent size profit fairly quickly. Maybe not tomorrow, maybe not Monday, but starting, middle of next week, if we quiet down, this thing is going to show a significantly bigger profit. And I'm going to show you that here in a second when we do a spread generator. By the way, hope you guys are enjoying the spread pattern generator. It was pushed to production of Trade Partner last week, so I hope you guys have been able to play with it a bit and have fun with it. We are continuing to improve it. I've got a list of about 15 things that we're going to be doing with spread patterns to improve what it does, how it does it, et cetera, including having templates so you don't have to create the spread, the same spread every time a new expiration comes. So that'll be pretty cool. I have no time frame on all of this. Quite honestly, the list for my programmers is so stinking long on my wish list, if you will, for Trade Partner. So they crank as much stuff out as possible. The Smart Fill, by the way, I have a Smart Fill new template for the Smart Fill. Looks really good. I was testing it yesterday and today. Got a couple of bugs in there, so I'll get another version tomorrow, and that's coming out very quickly as well. All right, I got sidetracked. Nonetheless, that's this is the normal 5-to-1 option insanity. This is a different 5-to-1 option insanity. If you'll recall, I said, $795 credit. And the reason I got into this one was because the time value on this thing, if the market just stayed the same or about the same, around 388 or lower for a week, this thing would be worth about $400 in profit. And so that's a lot of time value for this thing. Considering that the break even was still at around 392, maybe even a little bit higher than 392 technically. So I liked it. We moved down yesterday. I did go ahead and get out at a profit of $500. Now this is different because this is where the credit was $800 basically, right? $800 credit, meaning if the market stayed down, I'd have another $300. The problem is that on this particular one, if the market moved back up, I would actually, at least I anticipated that I would actually be able to get back in at maybe another big profit because of the value of the shorts. That being the case, it did not actually happen. The difference between this one and the earlier one is that this one has only 6 points difference between the short and the long. I don't know if you saw that. That's what creates the massive credit and the big time value of this trade. So I was expecting to possibly get back in. That actually did not happen. It did not materialize. The market did bounce today, and I got out at a $500 profit, and actually a little bit more than $500 profit. And it's basically trading at about 295 right now. So that one, I got out at 273, and it's trading at 295 right now. So big market jump. The credit did not come back. So there is the time value, and it is what is. And obviously, we are almost at the short strike, which is at 383. Or excuse me, the long strike, which is at 383. Short is closer at 389. And so since I had both of them, I decided, take this and maybe reestablish next week. So I'm going to consider replacing this one today with one for the following week, which would be February 12th, February 16th. All right. Then the other option in Sanity that I introduced the other day was this one. And it was one where you basically eliminate the risk on a massive move to the upside or to the downside. to some degree. Obviously, there's these little bitty hinges here, if you will, at the long strikes where you could lose a little bit of money. And that would be especially true if the market moved down further. So 380, that's not a big deal. However, the market moved down to 370, 371, and now it's back up. And all of a sudden, these 380s are actually worth quite a bit. So this is an interesting scenario that we've been able to stumble across here with regard to the timing of me showing you this, because the risk is if the volatility remains in the longs. Okay, so that's where the risk is. And I showed you a graph yesterday. So we're going to take a look at where these are at right now for the ones that expire tomorrow. All right, so if this were to happen, so this particular one, and I was filled on this, by the way, at an even Steven, 0 credit, 0 debit. And we're going to see, what happens in a couple of weeks if the market goes nuts, goes screaming to the downside, and then bounces right back up. What happens to these spreads? Well, this is a 385, 380, 390, right? So what I'm going to do is I'm going to bring this down here. Maybe. Hang on. All right. There we go. All right, so let's take a look at these. And of course, the structure is that you have longs that are 10 points apart and the short splits them. That's the structure. All right, so this is way in the money, way in the money. We're trading at 381. This thing is trading now at 370 or at 76, and this is again the one that expires tomorrow. And so if it goes way in the money, if you do this, it goes way in the money. You're talking about losing $70, $80 right now in an open position trade. That may not be the case tomorrow, but we'll watch it and see. And we'll just scroll down here. And so here's the 372, 382, and 377 is the shorts, and that's trading at a credit 57. So we're right around the 382 area here. And again, we'll see how much of the extrinsic value is remaining on the 377s come tomorrow. So I'll record all this for you guys. But if you want to watch it, you can put the spread up in Trade Partner and watch it as well. So let's just go to the 380, 390, and 385. Okay, I got it for an even Steven, and we're trading around 381, and this thing's trading at a debit of 71 cents ish. So I'd actually be making $70 on the 380, 390, 385. And the reason is because this 385 still out of the money. And that's why that's working the way it is. Now, if we move up to around 385 and volatility continues to come out, as it most likely will if we continue to move up, then this is obviously going to turn out to be a bigger profit because we'll be in the middle of the profit zone. All right, but if we move down, you can kind of see where, and this is actually fairly accurate. You can see where the value of the calls, or the volatility of the calls gaining in that scenario does pose a risk. It's not a huge risk, and it's certainly nothing compared to the upside risk of a 5-to-1 type scenario, but you get the idea. All right, so let's see what the biggest profit is on these. Looks like that's this one, the 379, 389, 384 is the biggest open profit. Okay, we still have a day left to go on these. And there is about, let's see, we're trading at almost 381. 381. So yeah, there's almost a excuse me, there's $2.30 of extrinsic value on the shorts and about $1 of extrinsic value on the long right now. So that kind of gives you an idea. $150, $200 profit potential is certainly within reason on this particular trade. Okay, so what about where the ones we got into? What has happened to those since everything skyrocketed? Are the prices better? Are they not better? Are they the same? So let's just do that. And so again, here's deep in the money, 52-cent credit. So there is a little bit of negative time value there on the 365, 375, 370s when the volatility moves higher, but it's not much, like 30 cents, 25, 30 cents. That's it. So you could actually do these and you create this profit bubble in the middle here at the 370 level. But if it moves down to 370, you're going to see volatility increase in there. So that's why I don't like doing the in the monies necessarily. Okay, so let's move on down to the 380, 390, 385. And we got in at even Steven, and it's trading at a 5-cent debit. So basically a break even is where this one is at right now. So there's not a lot of time value on these. It's a slower process to get there, but in order to get the really good prices, you do have to go out a little bit in time. And so because of the risk is so much smaller, you can do it, and obviously you can do as many as the margin will allow you to do, and of course you have to go out on the margin with these hedges. So the two shorts at 385, you go 415s. 415s on the margin hedges, that's 3,000 a piece. That's $6,000 to do this trade in margin, which is a pain in the rear that's the case, but it is nonetheless what it is. Obviously, it does not reflect the risk on the trade, but yeah, anytime you have shorts that expire after the longs, they're going to charge you. They're going to charge you extra margin. They're going to require extra margin in your account. All right. So let's move on to some crazy calendar stuff. All right. So this one is one that I put on a little over a week ago. Actually, I think it was a week ago now that I put this one on. And this one looked pretty good. Of course, this is just a real simple 388, 392 diagonal and only 3 calendars. And the 3 calendars were at 390, which is splitting the diagonal spread. So there's not going to be any dead zone there. And for a total of 37-cent credit. And let's go ahead and pull this one up and see where it's at. And as a matter of fact, what I'm going to do is I'm going to go ahead and do I'm going to do a spread pattern on this one, just so that we can compare the prices at different levels. All right, so this one is 380, 384, and then 382s. Sell and buy. Yeah, I'm going to bring this down in just a second. All right, there we go. So this one, and of course, Yeah, 3 of these. So here's one that's 380, 384, and the calendars are at 382s. You'll notice that the credit here is 49 cents. And I got in at 37 cents, way out of the money. So that's pretty good to, because let's see, we are a week and a day away. And if we were to move up here, I got in at 37 cents. If we were to move up to where mine are at, and I'm looking at 50 cents, that's about 12, 13 cent loss. Guess what I can do? I can replace this thing. I can replace it and create a credit that is much, much bigger than my loss and push the break even further up. That is available. You can't plan on that though. All right, that's the issue, is you can't plan on that happening. You have to accept the risk of whatever it is, and then if that is an opportunity, if it moves up there that way, then great. But if it moves up there, we're going to see the volatility come out of this stuff. So you're not guaranteed that you're going to see that particularly in place. Although I think this is probably pretty accurate to what we would see. Maybe not a week out. That's the issue here. All right, so let's take a look at this from let's start at 375 and then go to 395 and 1, and we'll generate the spreads. Now I'm actually on my test version of, I know they've been doing some work on this, so hopefully that doesn't cause an issue here. All right, so let's go up to 390 or 388. Here we go. So I got into the 388s, 392s, and then the 390s at a credit of 37, and I'm now making 22 cents on this trade. And we're still a long way away from 388. And again, the 390s would be the profit peak, but there's only 3, right? So now that's something that is always of concern. If you only have 3 calendars, then that's going to lower the profit peak, right? And if the volatility comes out, so would I take a profit on this? Yeah, I absolutely would, and I'd go in the following week. If I were kind of like brand new and I got into this, I would take my $65 profit. It was a week, right? All you got to do is average 20. I would take my $65 profit and try and get another credit for the following week, maybe even a little bit further out. And so we'll actually even look at that. Now take a look where we have to go to get 37-cent credit on this one at this point. It's all the way down to 381, 385. So if the market were to move up to 388 tomorrow, then we might see this profit come back down to about a break even. So let's see, where is it at? There we go. So we might see this 26, 25 cent debit actually go back down to a 35, 40 cent credit if we were to move all the way up there. So that is a possibility. It's not completely out of the realm of reality anymore, considering all the market conditions. But let's take the same spread and go one further week out if the strikes allow me to, and I think they will. I think all those strikes are available. All right, so the 380s, 384 diagonal with 382s going. That's in the money right now. That's basically right above the first short. It's going for a 94-cent credit, right? So let's go ahead and see what is available further out of the money. So here's the 384, 388, 386, 386. That's going for 39-cent credit. Man, the 388s, 388, 392, 390s, only going for a 7-cent credit right now. And part of it's because these calendars, so that 7 cents is the mid. You could probably get 10 cents on this. But that's because these calendars here are going for almost 40 cents, not quite 40 cents, 36, 37 cents. That's ridiculous for these 390s right now. And they've been kind of ridiculous lately, right? But you can go to 390, 394, 392s, and you can almost create a credit if that's all you want to do is create just a small credit and as kind of position yourself for the market to make a move to the upside. This is a pretty good one because the profit peak is at 392. All right, so let's go one more week out and see where we're at. Remember that one, the 388, 392, 390s. That's the one that we're comparing. That one's at credit of 5 cents. Okay, 5 cents. I originally got into one at 37 cents. So let's reset those, go 1 week out. So 219, 222, and 219, 222. Generate spreads. Let's go 388. Oh, we can't go. There's what? Are you kidding me? There's no 3. Oh, yeah. How dumb is that? They are not consistent with these strikes at all. So the 222 strikes are only available every 5 points. I mean, I have no clue who makes up these rules, but they're ludicrous. So we don't have. There we go. Here's one. Oh, sure. It's every 5 points until you get to what, 398? Jeez. Or 390, yeah, 398 and 396. Go figure that one out. So you go 1 week out, go all the way to 394, 398, and then 396s, and you still get a credit. I don't even think there's another one that's available because of the screwed up strikes. Here's one, 386, 390, 388s, 50-cent credit, almost 50-cent credit. So, yeah, you'd be waiting on these. That's for certain. There's not a lot of price movement on these. What's the next one that was available? Here it is. The 394, 398, 396, 396s. Those were actually trading at a small debit on the 212, 216. And so there is some favorable time on these, but it's not tremendous. These are the ones that you got to put on and set, and then a week later put on another group based on wherever the market is and set, and hopefully get out in a week or 2 weeks if available. All right, so let's take a look at this real quick in a little bit more detail on some, where is it? Let me see here. I believe this is it. All right. And I got to find the smart order file. There it is. All right, so this is a little bit different, but we'll just pull this over here. And yes, they did get PDS trader data issue with our data vendor all squared away. So that's been done. However, the fix was not permanent. They're working on a permanent fix. So it may blip out every now and again. Almost completely out of our control. Nonetheless. All right, so here, we've been talking about doing the calendar spreads and finding ways to pay for the calendar spreads. And there's all sorts of ways to do it. It just kind of depends on what you want to focus on. You want to focus on a smaller risk, or do you want to focus on a higher probability? Do you want to focus on a bigger profit peak? If the market moves up, do you want to focus on more bearish leaning? I mean, it really, this is why it's so important to have a plan on what you're wanting to do and how you're wanting to trade it. And, it may be that you trade it differently based on wherever the market goes, right? So if the market moves up, like it did today, maybe you start going a little bit more bearish leaning. If the market moves down, then maybe you try and put on, make this huge profit peak, and you're not worried about a credit because you already made money off the last one that you had a credit on, or whatever the case is. I don't know, everyone's going to be different on this, but the concept remains the same. You buy a bunch of calendar spreads as cheap as you can get them, and you pay for them, right? That's the concept, and then you take a profit when one is available. And it doesn't have to be necessarily a single target. You can play it like I do. If we're way away from the profit peak and I've got a $50 profit, I'm going to take it, because the probability of going back up into the profit peak is diminishing, right? Depending on how much time there is. If we jump past the profit peak and I've got a loss, and then the market comes back into the profit peak or around the profit zone, guess what? I'm going to take a profit, because at that point we're too close to the risk level. And certainly if we're getting to the risk level and I've got a profit, I'm going to take it. That's what increases the probability of these things, is when they're profitable, you take the profit. And it's just a matter of, okay, how much profit do I take? Because there will be times where you don't have the opportunity to get out at any kind of profit. We haven't taken any kind of serious loss on one of these in months. In fact, I don't remember I don't know that we have taken a serious loss in these on an official one on this call. And it's only a matter of time before the market does make a move higher and stays higher, because there have been a couple of times where it's jumped our profit zone, and then the next day comes back down, like on a Friday, comes back down into the profit zone. We end up banking pretty good, right? So that's why I say you have to be able to accept the risk, because a lot of traders, when they first start trading, they'll get in, and if the market makes an adverse move and they show a loss, they get scared and they exit. Listen, if you're getting scared on an open position loss, you're trading too big. I mean, that's just the truth of it. You're trading too big. So that's, for example, in GME, that's why I have no fear whatsoever of GME coming down and going below 10, because I kept my trade size, even though I think it is a tremendous trade. I'm not going to get myself into a jam under any circumstances. That's just the way I am on trading. I didn't used to be that way, but I learned, right? So I just don't put myself. Yeah, do I leave money on the table? Absolutely. The American airline trade, if some of you guys knew about that, I probably should have done 10 times what I actually did. And I did hundreds of contracts. I probably should have done 10 times that because of the probability. But I didn't want to put myself in a jam. If American Airlines moved down, I wanted to be able to add to the position. Same with GME. If GME were to crash tomorrow, I'd be adding to the position, because I've left myself room to do that. So anyway, it's kind of the same concept here. You don't want to be scared of the market making an adverse move. And if it does, you're trading too big for your account size. You need to slow it down, or you're not comfortable with the trading enough yet. Um, you don't have enough experience to not be scared, et cetera, et cetera. And what you're going to find with these, if you're consistent with putting them out of the money, is that the worst case scenario, the worst fear that you have, it doesn't exist most of the time. And if you're trading a proper trade size, it's not going to bother you, even if it does happen once. And for that matter, because all right, if it happened once, and we're trading at these like all-time highs, and it happened once, what's the likelihood of it going to happen again? Guess what I do at that point? I slant my trades way bearish. Not way bearish. I have a big credit. I focus on bigger credits, right? And this is something that I did with the trade, this trade here. I did this only 3 calendars specifically because I wanted a credit on this thing. And if I would have traded another calendar, the credit would have been like, I think around 10 cents, 8 cents, somewhere around there. But I didn't want to do that. I wanted a bigger credit. And so that's what I did. All right, that's got off kind of on another tangent. I need to pick things up here. Okay, so here is group 4. Okay, this is group 4, and I want to show you this here for a second. Group 4, and this, by the way, is about an 80-cent credit. Group 4 is leg 2 and leg 3. It's a short 389, long 392. And I know that might be kind of confusing, but I've got 4 different groups here, and I'm doing it to show the different combinations of what we're doing. All right, so group 4 is a 3-point strike difference. It's a short 389, long 392 from an 80-cent credit. Okay. I know this says 5 cent, but that's because this credit doesn't do it based on groups. It does it based on all of the legs, and I'll show you all of the legs here in a second on why those are there. All right, so this is group 4, 3-point strike difference. You have a credit of 80. That means the max loss is only 220. Okay, now I point this out for a very specific reason, because most of the trades that we have on is, worst case scenario, $400 to $500. Right. This one is only 100. Well, 220 would be the max. Most likely, you have a very, very low probability of realizing a $100 loss on this, because the market would have to move higher, probably around 392-ish. It's certainly, I shouldn't say super, super low, because that's not that far up, considering there's 2 weeks on this trade. But the probability of realizing the $100 loss versus realizing a $100 gain, or almost a $100 gain, is very, very skewed. It's something like the tune of 4.5 to 1, 5 to 1. All right, so this trade alone, you have a positive mathematical expectation, and those are the ones that personally, I like the ones that have positive mathematical expectations. All right, so what I'm going to do is I'm going to add to this group just 2 calendars. And those 2 calendars are, let's see, leg 5 and 6. So that's group 2. All right, so here is the 2 calendars. 2 calendars with the 3-point spread difference. Okay. Let's go ahead and just add all those together. So 392, 389, and then, all right, now we're going to look at group 5, which is those added together. All right, so here is your group 5. This is with 2 calendars, and I've got the volatility out of these for the most part, not completely, but for the most part. And you'll notice here that this particular trade is, it's not as crazy of a calendar trade as you could do, but it is a slightly bearish leaning crazy calendar. You've got about that's about a 10 to 15 cent credit on that. And your break even is going to be way up here at around 393-ish. And then your max risk on this trade is still less than $300. Absolute worst case scenario. Okay, so you can absolutely create lower risks by tightening those spreads up and not doing as many calendars and still create the credit, and you'll be fine. Okay, so that's one way. I want you to look if you want to create a small debit on something like that, which you absolutely can. Let me get rid of all these legs again because it reappears every time. So here is a very small debit on this particular trade. So you've got 3 calendars, you've got a 3-point strike difference, and you've got a nice little bump here, profit peak. And again, your risk on here is just at about $300, worst case scenario. And I mean, the market has to skyrocket for that to happen, because what has to happen is for all of the extrinsic value to leave the calendars, for you to realize the maximum risk. And that I've not seen the market move up in these kind of conditions. I've never seen the market move up enough to remove all extrinsic value out of the calendars, because the in the money options tend to hold their value a little bit more. And so these are actually break even for quite a ways up to the upside. So when I say your risk is $300, the probability of the $300 risk actually happening is virtually nil. All right, now, why would you, so this is a small debit. Why would you create a small debit on this trade? And the answer is simply, maybe there's some other way to pay for it. So, maybe you've got something else going on that allows you to put a bunch of these on. Maybe you got one bearish and you've got like 10 of these on, which is something that I do. I offset some of these. So I'll do like 10 of something like this, have a $150 debit, and then I'll trade one out of the money credit spread to pay for that entire debit with this massive, huge profit peak if the market moves higher. Okay. And again, that is based on obviously being able, once you get larger trade size, you can't do that. I mean, you could, but you don't want to necessarily do that if you're trading at 1. You start with this or a small credit, right? Do 2, a small credit, and you go from there. All right. So the other way to do this is if you're willing to accept a little more risk, then you can go with, let's say, actually, let's just do the whole thing. So here is a 2 small spreads, 2 credit spreads, and total credit on this trade is 61 cents. You have a small profit peak. You have a situation where the break even, you have a small profit peak at 392, and then it starts dropping down off that. So you have a pretty wide area where you can make some money on this trade. This one's a little bit more complex because I actually have a 4-legged spread with the calendars, and this would be 2 calendars, creating the 61 cent credit. Okay, so let me show you group 1, which is like 1, 2, 3, and 4. Okay, so this could be your trade to pay for everything. This is actually a $1.10 credit. or actually a $1.18 credit. This is a $118 credit, right? So this is more of a bearish leaning scenario. You have a profit peak here, and that allows you to put on some 92, quite a few 392 calendars by doing it this way. But your risk on this trade is a little bit bigger. So if you want to look at leg 1, leg 2, leg 3, and leg 4, okay, take the shorts. You got a 3 strike difference and a 1 strike difference. That's $4 difference total, right? Whereas your risk on this is still $300. Actually, a little less than $300 because you have a 4 strike difference total on all 4 legs, and you have a credit of $1.10. So that's $290 credit. So if you can bring in more on the on a more complex bearish neutral trade, if you will, which would be similar to this one, you bring in a bigger credit. That means you can pay for more calendars. Your risk is still only $300. Worst case scenario on this, right? So if I go, let me do this. Let me go 0, 0 on this so you can see the credit that is on here. All right, so that is a 117 credit here. 117 credit. Shoot, and I'm not going to get to what I wanted to introduce. Anyway, I'll get to it next time. So this is a 117 credit, and you can see here the risk starts to approach the $300 level at about 395. If you can put on if you can put on several calendars, 2, 3 calendars, 4 calendars at 392, and pop this up a bit, then you increase the probability of being able to take a profit going out of the profit zone. So we'll put 4 calendars in there at 27 cents a piece. That gives us a total credit of 5 cents, right? And so now here's what that graph looks like. Okay, so you have a much bigger profit zone area. You're not going to have this kind of profit if the market moves up here tomorrow. In fact, you'll have a loss, right? So you can't you can't expect necessarily, if the market immediately moves up, to have a profit on this, but that's a pretty big profit zone. You're not going to lose anything when the market moves down, and your risk on this trade is $300, or excuse me, $400 now that you have all these calendars. But because those calendars generally hold their value, if they go in the money, it's going to be hard pressed to get to a $400 loss on this trade, right? And I've already taken the volatility out of here for the most part. So this is going to be pretty accurate if you hold on to the last day. We, of course, do not want to hold on to the last day in most instances. Only if we are down over here at 395, 396, do we want to maybe consider holding on the last day. If the market, if that happens and the market doesn't come back down, which is the last 2 times it's gone past my profit zone, it has come back down. But if it doesn't, then that's when I get really, really big with my credit on the next trade. I roll the thing, and I have this very, very bearish to neutral trade in place. Okay. All right. So I would encourage you to go through, use PDS Trader and play with this stuff. Just make sure you pull the volatility down, because we're pulling it directly from our data vendor. And as I've said many times, I know y'all are probably sick of hearing it, but you cannot rely on the volatility remaining where it's at today in 2 weeks, especially on these Monday options, right? So you got to pull that volatility down. I go 0.10, 0.09 would really give you the scenario if you waited until the very last minute of the very last day to get out of these trades. But this is a pretty good rendition for the last day, as long as you don't wait to the last minute. So that's kind of where that's at. Again, very, very high probability trade. Let me pull this down here. This was trading higher earlier. It's now trading a little bit lower. Of course, we were trading at about 381.50 when I was looking at this as a possible trade for today. So here's what it looks like. The 388, 389, those are the two shorts, right? So they're pretty close together. And then you got 390, 392. And the whole thing going for a credit of about a $1.07. And by the way, I like this trade. I like this trade without anything else, right? Yeah, your risk is 3-1, worst case scenario, but it gives me all sorts of opportunities to possibly put on the calendars at a cheaper price, maybe buy a hedge, et cetera, as long as it doesn't move up immediately, right? So I like the trade by itself, and that's always helpful when you have a mathematical probability that exists on the trade itself, because the break-even level on this is going to be around 392 is where that's at. And of course, we're trading under 381 right now, right? So I would probably put this in for a credit of like 115 because we were trading at 118 earlier today. So I'd probably put this in for a credit of 118. So order one, credit of 115. Okay, so that's order one. And then if order one is filled, then execute order two, right? So if order one is filled, then execute order two, and we'll go with a debit. And I'm going to do, you know what? I'm going to do 3 of these because I'm still not that bullish. Yeah, we could move up there, but I'm not going to create the entire trade. So I'm going to put that in at 0.27 on a debit. We'll do 3, and that's what I'm going to do. Now I've put the other spreads in here. Here's 389, 382. That one alone is going for a 65-cent credit right now. Okay, so you could do 2 calendars, and you have 389, 392. Your max risk would be about $300 if the calendars lost all of their value way up there. And you would have a small profit potential. 390s, those are showing, that's not 30 cents. Those 390, the 390s are okay, that makes more sense. 390, 392 is the other side of that spread. So that's where you get the added 30 cents on there. You could actually do a 392, 390, 392, and then 2 calendars or 1 calendar on that. And you have like a 1-2 punch trade type deal. Okay. Do you want to see that? Sure. So that would be, so we'll go 2 calendar. No, let's do 1 calendar with the 390, 389. Oh, I did a 389 and 390. So let me rephrase that here. Uh, 389, 392. Let's go with 389. 390, I believe is. Alrighty. Is that what we had? 388, 392, and a 389, 390. Yep. 388. That's the issue. 388, 392, so 388, 392. So this one is actually 388. All right, so that's the 4.388. 38, 392, that's 4, that's 5. So that's actually a 5-point strike difference there. Not a 4-point strike difference. All right, so there's the 388, 392, and then the 389, 390. So you get majority of the credit on the 388, 392. This just props it up a bit. The 389, 390 just kind of increases the profit peak just a little bit further out. Okay, so those are the two separate spreads. And of course, you can do this. 388, 392 as one as well. You get 98-cent credit. Then you can do like 3 calendars instead of 2, and still have a pretty decent credit. So that's trading at a $1 credit. This is similar to what we've been doing, only the calendars are at 392, right? Instead of 390, which is what's splitting them. All right. So I'm going to do the whole thing. I'm going to do the whole thing, and I'm going to do it exactly like we have it. 3 calendars. And I was just going to wait for this to get filled. We were filled, by the way, on the 84-cent one that we did the other day. So I'm going to save this, and then I'll turn it on. Then we'll take a look real quick at the one that I was filled on the other day. All right. So move that out of the way. We'll see if that gets filled at some point today if the market makes a move higher. All right, last thing, and then we are done. I know I'm already out of time. Here's the trade that I was filled on Monday, and it was filled at 3:56 p.m. Eastern, so it was like right before the close. This is the one where we did the 388, 394. I was more willing to accept a bigger risk on that and do some 390s. I did 390s, 390 calendars for an 84-cent credit. This was as of Tuesday. Okay, it was actually losing about 27 Tuesday or Wednesday. It was actually losing about $27. This one right now, if I were to bring it up here, where are you at? If I can find it. And I can't find it. So let me, oh no, I know where it's at. Sometimes I forget which which account I'm putting these in. And so we will go to that one. And let's see here. Here it is. All right, I'm going to bring this one down. Maybe. All right, so there's that one. And it says a $20 profit, but the mid is actually at 50. So I actually have about a $40 to $45 profit on this. The bid-ask spread is pretty wide, so it's giving me the bid. I got in at a credit of 84. It's giving me the bid of 62. That's why it says $22 gain instead of like a $40 to $45 gain. But again, this is one, this is 212, 216. $50 on this is not a bad trade for 4 or 5 days, right? We're still a long way away, and it is a fairly big credit. And so, I'm not opposed to holding this on for a bigger gain. But again, somebody who hasn't experienced success, somebody who maybe it's their first trade, get it under your belt. There's nothing wrong with it. Take put it a $50 target in there, and call it a week. Get into another trade further out, type deal, or further up. But watch this one. Watch this one to the end. Um, and uh, and the more you watch them, the more comfortable you're going to be at making decisions on when you're going to exit. All right. All right. Let's go ahead and take questions. All right. Can you please show the 121 Sandy option trade again this week? Ariel, so the graph that we did this the other day, and I showed you a different graph where the volatility doesn't come out. But the great thing about this one is that this is not one where the volatility usually stays in. If it's where you're at, if the market moves down, then the volatility comes back in. It's going to show you a different graph, but you got to take that volatility out. Okay, this one may not be exactly like this. It may, the 380s actually may drop down to where you're seeing a 30, 40, $50 loss. And then the profit peak may be down a little bit. But if you don't see a graph like this, it's because they're showing the volatility as being way too high than what is reality. It does not stay the same. Okay, let's see. Richard sold a bunch of February AMC 150 puts for 20. Yeah, that's pretty good trade. Pretty good trade. At the course of January, I opened and closed 9 trades in crazy calendars, averaging $55 per trade, including one losing trade. I am very satisfied with this. However, in 5-1, I closed in January 3rd, trades averaging. However, in 5-1, I closed 3 trades, averaging $268 per trade. Hope to keep doing like this for the rest of the year. Great, Mike, sorry. I almost said your last name. So here's a guy, he's closed out 9 trades in crazy calendars, averaging $55 per trade this month alone. So these guys are doing it. It's just a matter of getting into a rhythm. And once you do, it's a wonderful thing. Then he does the 5-1 option insanity, and on 3 trades has averaged $268 per trade. Excellent job, Mike. Excellent job. It's an inspiration to many other traders. Let's see here. Hi, Ryan. Can you enable the spread generator for us that we don't have trade partner linked to a broker? Yes, Juan, they are actually going to be doing that. We've already got them in that started on that process. Can you transfer a trade possibility from PDS Trader directly to Trade Partner? Carl, not yet, but we will be. So we're completely rebuilding PDS Trader. It looks completely different. It's just a huge task, but it will be able to talk to Trade Partner. Maybe not on the first. Maybe not on the first release, but it is something that is in the plans. So it's in the framework of doing it. So they have topic. I watched the webinar on stacking risk-free calendars again. Are you sending signals for that program? I am not, Skip. I was going to, and then I decided not. It was not until I can do so on a more consistent basis. I'm spread too thin. Yesterday on the fall, I did sell 2 to cash on volatility. You advised to do it every time I see volatility spikes. On the fall, I did sell 2 by 3 strikes away to cash in on volatility. Ooh, you got to be careful doing 2 to 3s. You got to be real careful about that. I see all these spikers. Is there anything else to be aware of to do on that trade? I'd have to see the trade exactly. What's your credit? What are the strikes? to be able to give you any more information on that. Hi, Ryan. Are there profit stacker opportunities available? Yes, there's always profit stacker opportunities available. Profit stacker is just simply a merely of exiting a trade and then getting back in at a better price type of deal, or profit stacking, for example, on the calendar spreads. I know some of you have been pretty consistent at doing the risk-free calendars and stacking those. So if you have, let me know about it. Can you show us how to have trade partner keep putting on the trade over and over if the original 2 orders are filled? In other words, keep repeating the trade. Yeah, Robert, you betcha. So where is, let me find this one. So I'm going to do new system, and I'm just going to go through. This is not obviously not what I would absolutely do, but I'm going to put it in here. 385. Whoops, not that one. So I'm going to add an order. So let's say I'm wanting to do risk-free calendars, right? 385. All right, so I've got, if I do a sell order first, obviously, if you do this, you have to have a margin hedge, which is not that far away, depending on how, which expiration you're doing. All right, so this is going to be order 1 on a limit of, let's say, 25 cents. 25 cents. If order 1 is filled, execute order 2 on a limit of 25 cents, right? And then we'll go if order 2 is filled, then we'll execute order number 1 again at 25 cents. And then if order number 1 is filled via action group, order number 3, or action group 3, right? If order number 1 is filled via action group 3, place on order number 2 again at 0.25. And you just keep going down. As many as you do, you can repeat the order over and over and over again, up to 8 times on here. And with that, what I do is most of the times you're not going to get filled on this, more than a couple of 2 or 3 times a day. I think 5 is the most times I've been filled on it one day. So I start the whole process over again the following day. I don't try and do these, weeks on end. For those that can't get accounts with TradeAir and TD Ameritrade, can we get full use of the features in Trade Partner? So the spread patterns are going to be added to there. I don't know what other feature you would actually be able to use. Obviously smart orders are for actually placing trades. The smart fills are for actually placing trades, that kind of stuff. So is current situation better for crazy calendars than risk-free calendars? Patrick, no, not necessarily. So the risk-free calendars are just simply, you got to make sure you're going far enough out of the money. If you start the sell leg first, you got to make sure you're going far enough out of the money to not create an undue risk scenario. With 501 option insanity, why no just sell a naked call? Well, the reason you don't just sell a naked call, Kevin, is because a naked call doesn't create this profit bubble. This profit bubble is what increases your probability of being able to get out of the trade at a profit if it's moving up. That's why you don't just sell. If you sell a naked call, you have nothing but a straight line. And early on in the trade, this straight line actually begins dipping down, 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 right? So you don't have this profit zone, this profit peak, the profit bubble. And the further you go out, the smaller the credit, the bigger that profit bubble. So that's a $750 profit bubble. You sell a call, you're not going to have $750 possible, period, end of story, right? So we are doing this to increase probability and profit potential of the trade. And by the way, you definitely want to have the margin hedges in place. Let's see, I got out of the 388, 394 yesterday and resold today, still have the calendars. Oh, excellent job, Lewis. Great job on that. I haven't talked about this in a while, so it is great to see you guys implementing this stuff. So Lewis here said that he got out of, and it's not this exact one. He was in the 380. It's this one. He got out of the 388, 394 at a profit yesterday, and held on to his calendars and resold the 388, 394 today. And you can do that if that's why we get out of the calendars on a target. If we can get like 85, 90, 95 cents on those things, if the market comes crashing back down, you can rebuy them if you want, but you've taken the profit. Or if the market moves back up, continues moving up, you very well may have taken enough profit to obliterate the risk on the diagonal. And that's the same thing with the diagonal. If you can take most of your profit on the diagonal, and still have the calendars and maybe resell another diagonal, that's a great planning, Lewis. Let's see, the whole graph is under the zero line. So the whole graph is under the zero line, Ariel, because this volatility number is skewed. You move that volatility number to a normal number, and you're going to be just fine. Could you ask Spring to send me the total course of overcoming? Robert, we do not have that available just yet. We're trying to recover it. We're trying to recover the old one, and so we'll let you know. Thanks for the spread generator. Got all my stuff organized and able to look at things very quickly. Awesome, James. Why those strikes are not available on spread generator? It is Trader brokerage. Is it? You know what? I haven't looked at IB or TD Ameritrade, to be quite honest. Is it Tradier? That might make more sense. So I'll have to see if that is the case. All right. Awesome. Thanks for showing how to repeat an order. You bet, Robert. Who's Spring and how are the Spring and the Twins doing? Thanks for asking, Richard. Spring and the Twins are doing just fine. She's getting nice and big. So they are growing. Appreciate the question. All right, we are 20 minutes into overtime, and looks like I've got all the questions. What I was going to introduce today is actually using a UVXY put spread to pay for your calendars. So didn't get into that today. Want to be cautious with telling you that that's what I'm doing, because it's definitely a different beast, but it is nonetheless interesting. And so I'll jump into that a little bit more in Monday's call. And by the way, I may have to postpone Monday's call for Tuesday. I'll let you know for certain as soon as I know for certain as well, and you'll get an email and a schedule change on that. All right, everyone, have a wonderful day. I will see you early next week.